Namit, welcome to the Global Policy Podcast. I'm really excited to have you today. It's really been a pleasure to see you again, and thank you so much for joining. So let's dive straight into it. Most banks actually still run critical systems on, their core infrastructure on legacy systems. And of course, Thought Machine has actually been in the forefront of really modernizing, what banking, stack needs to actually look like. But I'm actually very curious from your standpoint, what is the uncomfortable truth that you actually tell the bank CEOs about their stack? And what has been the feedback so far from these senior management of financial institutions around the world that you've actually worked with?
Thank you for having me. I think most of the CEOs are aware that the stack that they carry right now is cracking. They know it because the maintenance costs are going high. They know it because when they want to move fast to offer new innovative products, it takes longer time to get to the market. And they get feedback. They get feedback from their customers, they get feedback from their own internal team members. So it's not that they're not aware of the fact that the stack is old and limiting, but you have to also look at the problems that they are facing. Changing any core system is like doing a heart transplant while you're still running a marathon. So I identify with their pain and the time it takes to decide to move on these things. But a lot of them and most of them agree that the problem exists and it has to be taken care at some point. Having said that, I was told by my own colleagues and partners that it is a three CEO problem. The first CEO identifies it, the second CEO kind of gets fired while trying to do it, but the third one becomes successful at it.
I'm just going to stop you there. I want our audience to actually understand why this is actually very important. Of course, the core banking engine is the heart of the bank, isn't it? Why is it so hard that it takes, multiple CEOs to come and go for the actual heart of the bank? Is it the data stack? Is it, could you unpack that a little bit more?
Yeah, look, like you rightly said, it is the heart of the bank, right? So, again, going back to the running analogy, I mean, you can have the biggest muscles in the world, but when you run and you want to run fast and long, it's not the muscles that get tired only, it's the
Yeah.
heart that gives out, right? So that is why, the core banking takes the bank long and fast if it is a modern core. Now, why is it so complex? There are so many
Mhm.
integrations in and out of the core banking solution that changing one part of the core affects the entire bank. And it is also the heart in the sense of being an immutable ledger where the transactional data sits. So anything that goes wrong, and if it is not captured well, affects the entire upstream and downstream systems that might be connected to it. And that is why it is most important for the banks to get their ledgers right.
Thank you so much for that. I think, of course, it's a very critical thing to do. But I think most financial institutions I have actually also been privileged to speak to over time, they've actually found a way to kind of build around the old core legacy systems that they have actually had over the years. But how has that really shaped the competitive nature, for example, competing with the likes of more challenger banks who are more agile and nimble, who doesn't really carry that legacy stack? How does that kind of strategy help or does not help the banks?
Yeah, I mean, the simple answer is that all the challengers and neobanks, they have an advantage of no baggage when they came to the market, right?
Yeah.
If you really peel back the heart of banking, it is trust. And some of these big organizations, the GSIBs, have earned that over hundreds of years, that the neo and challenger banks cannot match. Now, with that trust also comes a little bit of legacy. And if we have to go back a bit, when the digital ledgers were started back in the 60s and the 70s, which we now call the first generation of, core banking, at that time, it was just, you know, booking the ledger and then moving on. All the products were also written at the same time on a mainframe, you know. As we went into the second generation, you had client and servers. This is in the 90s. And then came the digital veneers over this analog, cores. Talking about the early 2000s, this is also where I started off as a software engineer in the core banking business. And most of us at that time were, putting the digital veneers on all of these old core banking systems. What that means is it was the era of mobile banking, it was the era of digital banking. So we were all beautifying our front ends to give easy access to our customers. But behind the scenes, there had to be a lot of bolt-on logic on top of the legacy, a lot of spaghetti code that was added here and there to make sure that all of the front was held together with a glue so that not to expose the complexities of the back. And the limitation was also the fact that at that time, the APIs, the microservices, the technologies that we have accessible today actually did not exist. So there was
Yeah.
always a way to make sure that we give access to our customers who were changing fast in the digital world, but at the same time hiding the complexity. And it worked very well in the early 2000s. Even now, actually, a lot of banks are in that third generation world where the front ends are very beautiful, but the back ends are still old. Now, this was only at that time in early 2000s that me, as well as some of my like-minded software engineers who were, young, used to always ask this one question: why don't we, write a code that is front to back, completely new, and, give something that is fast, less complex, performative to our end users? Of course, we were naive at that time to understand that, it requires a lot of effort, money, tools, technologies, and most
Time.
importantly, time, yeah, to make sure that we all can do it. And so that's where we stopped and kept our heads down and kept doing, the front ends and then connecting it to the back ends.
That's actually very interesting. And I'm going to actually go back to a very interesting LinkedIn post that you actually made in the last, I think, 1 month or two at the New York conference that you went to. You mentioned that, quote, financial institutions cannot lead in AI or tokenization with a legacy foundation. And I think you've actually touched a little bit on some of the critical pieces of this, but I want to actually highlight AI and tokenization. Why is that going to be very different from a bank that has actually, bolt on top of their legacy system? Why wouldn't they be able to actually lead when it comes to AI and tokenization?
Very, very complex question because, first of all, tokenization and AI, while they both started off in a completely different stream, now you can see that there are a lot of areas where they will and they can come together. I always was in the core banking and core backend solutions for almost 15, 16 years when I started my career. But in the last 4 or 5, I also had the privilege of working with SAS Analytics, which is also a 50-year-old analytics organization, who's pivoting now from AI into now Gen AI into now agentic AI. And I was able to see beyond the core banking in those few years where I was in SaaS and working with these financial institutions on how they were using analytics, pure analytics, predictive analytics, not even going towards AI as such, but how this was going to shape in the future. So, coming from that lens, as well as the fact that I have dealt with a lot of core banking legacy solutions, I think talking about AI itself, because you have so many spaghetti code, bolt on solutions, it is very difficult for even the engineers in the bank to know where what exists. These data are trapped in the core banking solutions. And if you see, forget AI, which is, frontier beyond predictive analytics or analytics in general, it all starts from getting access to the data.
Yeah.
Right now, a lot of banks are having so many silos of these old legacy core banking solutions that a lot of them are actually solving the problem of data pipelining, getting the data ready for consumption for their different businesses, which eventually will be fed into their analytics and eventually artificial intelligence solutions. Put on top of that tokenization, which is basically digitalizing your Could be deposits, could be money, or how you move it through the infrastructure, whether it is on chain or off chain. The issue compounds multifold, right? Now, and if you put them together, which means how will now, where we are going in a world where we are talking about not you and me discussing with our banks or our relationship managers, or if you go institutional, finding the fastest or the cheapest way to do business with a bank or to send a payment cross border, how will an AI agent now work on your, on my behalf, or an institution's behalf on one hand? And on the other side, on the bank side, receive the request, find which system or area to talk to within the bank to get the best solution for the institution or the individual. We both, at both our ends, need access to APIs, to microservices where we can talk in a digital manner, enable our AI agents to speak, to find in a digital manner. Behind the scenes, we need modern solutions, API-based, microservices-based solutions, legacy code, legacy solutions that maybe sleep for 4 to 6 to 8 hours every night. And the night depends on where the bank is around the world. It seems it will be very difficult for the AI agents and the tokens to work in that world.
I totally agree with you because I can imagine that can be a major risk for a bank to actually, deploy agents on, spaghetti code. I just want us to take a step back because for the purpose of our audience that may not be actually versatile with some of the latest development that is currently happening in the financial service world, can we quickly kind of unpack what is stable coins, what is tokenized assets, what are the differentials between some of this? And how does AI agents, with the trajectory of how the market is actually moving of recent, how does that, three worlds actually collide?
Yeah, so look, again, if we go into the history of this, and then there is a lot of technical jargon as well. So I'll try to simplify as much as I can. Digital money on the retail space, institutional space already exists, right? So what is tokenization and what is stablecoin per se? I mean, this is the crypto and blockchain movement that got these terms as well as these concepts into the mainstream. Because if you go a decade back, where Bitcoin really became a buzzword, people started noticing it because it went, in terms of an investment higher. Governments and banks started noticing it because there was a lot of emphasis on the fraud, the black money, the terrorist financing, and the access
Yeah.
it could give to some of the elements in our society which was ungoverned, which was the promise of blockchain, which was the promise of at least cryptocurrency at that time, right? Now, through that is what tokenized assets as well as now stable coins have evolved, right? Now, tokenization is just, let's say, a claim of a digital money to a bank, right? So while stable coins, as the name suggests, is backed by some real asset. So just for simplicity, let's just take US dollar, right? Because that's something
Right.
that is well governed across multiple geographies now through the central bank. So for you and for me and for my kids, when I have to make them understand, it's digital money that is backed by a dollar is just another asset that you and I can exchange to do business. Why is it very important for all of us? You know, banks do not want to be left behind. That is the beauty of the banks, right? Banks have always been in the forefront of adopting new technology that is at the forefront, but always doing it in a manner that does not erode trust in them, that is put by the consumers like you and me, as well as the fact that they're governed by central banks. It ensures that that trust exists to the public. And that is where you have to be a bit commendable to these banks. Even though, 10 years back, when we were having these conversations, we were saying that the banks will be left behind. This is the end of banking. Look what happened. Banks adopted, and now they are moving 300 trillions of dollars, at least that's the figure from the US,
Yeah.
across payments in stable coins from the US. So they have actually done very well. And stablecoin is just a stable, compliant, trusted way of moving your money through crypto rails or chains, as we call them.
That's actually a very fantastic summary. Is it that the monies that we've been moving, from bank to bank in the last 50 years has not really been a digital money? What is the difference between, that, normal bank transfer that we actually make and maybe a tokenized deposit and maybe from a stablecoin perspective?
Yeah, I don't think it will be right to say that that was not digital because, how do we define digital? Think about those times when one of the big banks over here in Bank of America introduced checks and then, Bank Americard. And so was that not digital? That was digital because at the end of the day, if I am able to take a picture of my check today in Bank of America, for example, or any other bank that I'm now banking with here in the US, and if I'm able to not go to the branch, upload my check and get my money, I mean, that is also digital, right? You and I are anyways transferring to our family, friends, as well as making real digital payments through Zelle or in Singapore through PayNow, FedNow, and stuff like that, where I'm able to send money to my kids and it is available in their accounts digitally, in a split second. So at an individual consumer level, this was, I think, happening now for almost 5, if not 10 years already. And again, talking about digital, that's been going on for a long time. So what's the difference now between tokenized stable coins and stuff like that? Payment has always been like a message I send, especially on the institutional side, to my correspondent bank overseas, and I let them know that this is an instruction, payment instruction that I'm giving to you, and whenever you are ready, we will move this money. Now, usually that took 3 or 4 days. Even now, if I have to move some money from a consumer perspective from my bank in Singapore digitally on a wire to Singapore, it does take 48 hours. Now, as a consumer, do I worry about it? Maybe, maybe not. If I'm in a hurry, yes, it frustrates me. But in the bigger scheme of things, I can live with it, right? But that's not the
Yeah.
same when you are doing institutional payments. That's because it's high value. It's not the same when you are doing settlements for large trades that you, as an institution, or even as a high net worth individual, might be expecting for your business. And that is where I think right now the difference between digital banking and crypto, stablecoin, and tokenized movement of money is what we call programmable cash. It's not
Yeah.
anymore about just sending an instruction of a high value payment. It is actually moving the payment, moving the asset to its destination rather than only moving the message. So, just to give an analogy, if I send you an email today versus
Yeah.
if I send you a telegram, the difference is the time that it takes to send. If I send you an email right now and I say, hi, we need to do something together because it is important for our banks, our institutions, you get the message, we can get on to the next steps. It is the
Yeah.
same for programmable cash. Imagine if I send you an email and it says a ding and you get money that you can actually use. That is the difference between
Right.
digital money check payment instruction that we have been used to sending through other rails versus a stable coin which actually moves the asset to you right away and right now.
That's very, very interesting because I myself have been very curious about the stable coins market of recent, and what actually informed that is the exponential growth, if you like, we all have seen in the market. And that, changed a lot of my perspective about, the crypto currency story because personally over the last 5 years there's a lot of story around cryptocurrency and the likes. I personally have not really tried to kind of invest in those kind of assets because of course the volatile nature of it and the likes, but of recent, in 2026, it just felt like everybody just woke up to the reality that this is going to be a fundamental part of the critical infrastructure within the financial services. And of course, a lot of executives still have a little bit of bias around the crypto story. But for you personally, What really shaped that narrative of, okay, wait, this is actually a real infrastructural story, not necessarily just, a crypto story.
Yeah, see, I think one difference is that working on the core banking solutions for so long, actually, now that I think about it, was a privilege because knowingly or unknowingly, we entered this space in the early 2000s, and it gave us access to a lot of behind the scenes things that were going on,
Yeah,
in banks, which as investors who may or may not have done, banking or core banking may not know, right? So that was the first advantage. Even at that time, different ways of making payments did exist. I mean, there were checks, there were ATMs, there were RTGS, there were Swift. And we were, from an engineer perspective, trying to get all of these together in our core banking to make sure that we have a solution for our customers and our front end staff in the bank for each of these payment types and payment methods. And it has not changed over the last 20 years. We've just kept on adding it incrementally. For example, in 2000, we started in Singapore adding pay now or the faster payments in multiple countries as they came along. And now people, at least on the institutional side of things, trading side of things, settlement side of things, are asking for, crypto, stablecoin settlement solutions as well. So
yeah,
for me, it's not that everything will completely shift on anything that comes in new, but don't forget we have 4 to 5 generations living in this world together, and because of the standards in the healthcare in multiple countries, there are more and more generations that will live together for longer term. And each generation has a comfort with 1, 2, or 3 types of technologies and types of, for example, in this case, payments that they are comfortable with. And that is never going to go away. I mean, there are people who still like to go to the bank and use checks, and you cannot
yeah,
have them out of the system, right? There are
absolutely.
millennials and Gen X, maybe, who will have cryptocurrency as their main portfolio for investment. I hope not for their own sake, but it is a reality for a lot of people, right? And so for them to move money through these stable coins or even blockchain and crypto assets, which are beyond stable coins, maybe not as stable, is not something that they are really worried about. It is, a way of life for them. Now spending almost, 20, 25 years in the industry, I don't think any of those are going to go away. But this stablecoin cryptocurrency shift is a fundamental shift just because it is not only a payment instruction, it is fundamentally changing the fact that you can make the payment, move the asset as fast as the speed of internet.
That's very interesting, actually, because I really like the analogy that you made about the generational stack. That so many other generations actually live in this world, and that brings us to the conversation around agentic AI and programmable money. What we've seen in the last couple of weeks is, of course, the likes of Visa, Mastercard have been in the forefront of actually rebuilding this stack to be able to actually enable some of these use cases. Of course, we've been seeing other PSPs as well within payments or financial services already deploying this to live production for customers to use. I was looking at LinkedIn a couple of days ago and I saw Circle, the major company behind stablecoin itself, have already launched AI agents to be able to actually move money, so to speak. But bringing this back to the banking world, of course, that there's a major shift there where there's a lot of regulatory compliance requirements and the likes. But I'm very curious, how long do you think this is going to take for banks to start kind of thinking in adopting this type of capability? For example, would retail banks allow AI agents to move money on behalf of their customers? What would that really require for a bank to be able to do?
Is it really required? So, if you think about it, in a banking world, retail banking is where you need the most automation because you have the most customers who need a lot of attention for low value payments, when you compare to institutional, high net worth individuals or even mass affluent. So, retail segment has always been ripe for automation.
Right.
That's where we saw digital banking come first for retail and then for corporate customers. That is where we saw, the ability to move money fast on For example, PayNow in Singapore, FedNow over here in the US, Zelle, Venmo, and all these other neobanks who came. All the innovations are happening in the retail sector first. And that is why I feel that this is a segment that is definitely ripe for any kind of agentic work, right? It is a tedious work. I mean, think about the fact that if I have to go um, and find what is the best home loan 20 years back, I had to make a call maybe to
Yeah.
different banks, right? Then came the innovation where during internet I could go Google, maybe do my own work on the internet and get 10 areas and figure out what is the best deal for me. Then came the aggregators who could do it online for me on my behalf. And then
Yeah.
came, now we have Gemini, Claude, and, the other areas who can do it for us, but we are doing it.
Yeah.
Now take this and put it on an AI agent that, you and me can write today, at least on our behalf. Give it a problem and it can go and find out what is the best solution or at least give us the top three. Why can't bank do this? Banks can easily do this today. The only thing stopping them is spaghetti code, legacy code, solutions that they have right now that stop for end of the day calculations. They do not have real time data. The data is trapped in multiple core solutions
Silos.
that they have. And this is the only thing that is stopping them. I mean, think about a very fast agent that never sleeps, but then it has to wait for the bank to confirm or complete its end of the day. The bank agent has to now wait for a cross border bank to wake up because its working hours is 9 to 5 in a different time zone
Yeah.
and it has only a small window to work together. And think about it, it will not work from an agentic AI perspective. The promise from the business perspective is itself the fact that it can work 24. It should not have any limitations in terms of working hours, in terms of human follow the sun approach that we use right now across the globe and the likes of that. Now, to enable such rigorous automation, the banks have to be ready at their end. The bank's partners have to be ready at their end. So this is a problem at scale which not only one bank can solve. And this is what I
Yeah.
heard actually. I was at one of the on-chain events that you mentioned in New York, and this is one of the areas where a lot of institutional bankers were worried about. That, I am working on my own infrastructure. I'm changing it to an extent that I can make it 24/7. I can make it modern through modern core banking solutions. But what if others are also doing it, or are they doing it? What if others are doing it in a manner which will make it more complex for us? Because don't forget, if I can't talk to my correspondent bank because they are not working with me to create this infrastructure now on agentic AI, on stablecoin, crypto,
Tokenized
tokenized
assets.
assets together, then I'll have the same problem where the silos that I created internally for my bank will now multiply at scale on an institutional level between countries, between regions, and between institutional banks.
And that's another level of fragmentation that we actually bring in whilst trying to making sure that some of these new technologies are adopted. One thing I actually wanted to say is from my own experience working with some banks here in the UK, I'm just trying to get your thoughts around how banks should think about their existing roadmap. So take, for example, in the last 18 months before agentic AI became a thing, right? Banks already had existing roadmaps that they actually want to deploy from product perspective. And the market has changed. The customers are expecting new type of experiences, from a digital first perspective. How should banks really think about their roadmap as customers' preference are now changing? Because a lot of banks are currently stuck in, should we just continue our existing roadmap because we started building this product for the last 18 months and now we're ready to ship? The market has moved, around customer expectation. Just to give you a bit of context on that, I was speaking to a business bank in the UK, their head of product, and she saw the value proposition of what we were trying to kind of help them deliver. But unfortunately, they recently launched a new product that would have actually been 10 times better, if they have actually leveraged some form of agentic systems to actually enhance the customer experience. But because they've been building that kind of technology for the last 18 months, they've spent a lot of money. How should product teams, technology teams within financial institution rethink their roadmap?
The more I have spent time with bankers and in banking, all of them agree to one thing. Why was bank started in the first place? We were anyways exchanging goods and services with each other. Bank was started because we wanted to have a trusted and a single currency or a source where we could exchange the value of goods in a manner that is predictable,
Yeah.
right? Now, if you go back to that heart of what banks do, they provide us with a safe place to keep our asset so that we can use it to create or get some value, right? Now, if you really go to that extent, whether it is money, whether it is loyalty reward points, whether it is carbon credits that now banks, are giving to their customers, or whether there is now stable coin or any other asset or currency that comes in the future. At the end of the day, it's just another asset that
Yeah.
should sit in the ledger of a bank, which a customer can utilize based on his or her preference. I mean, if I'm going today at a cafe that accepts carbon credits for me to get a coffee, what stops me to pay with my carbon credit or my loyalty point or my US dollar or my Singapore dollar or my stablecoin, right? From an end customer perspective, the more I speak to banks, the more this is where they want to reach. They want to make banking seamless, easy, simple for the end customer. Now, if you look at it from that perspective, complexities arise when banks do not have the technology available to do that in a simple manner. And that is why you have now multiple ledgers that the bank unfortunately has to deal with and to keep balancing. So for example, bank has one ledger or a core banking solution right now to do, let's say, for example, their currency USD assets. But now then stablecoin comes, and because the old legacy core banking solutions cannot manage it, now whether it is because of atomic settlement issues, whether it is because the stablecoin asset was not defined in the old core or it cannot be defined, they have to go out and now and maintain that outside their old core. And now loyalty reward points are maintained in a third place, carbon credits in a fourth place. And I'm pretty sure there is something new that will come in the next few years that they have to, grapple with somewhere else. And then they have to, make sure that all of this syncs with their current core, eventually, a US dollar for their end customers. And now you end up with 3 or 4 systems, and it becomes a nightmare now to make sure that the ledgers are managed together. And this is exactly where a modern 4th generation cloud native API based microservices based core solution can help. So one ledger to rule them all, so that if today is stablecoin and tomorrow is something else, you can still put it on a modern single ledger that can make sure that it can move your money or any other asset off chain, on chain, even have a credit card that is being paid in loyalty, stablecoins, USD, SGD. Think about it from an end customer perspective, how does it matter? But from a bank perspective, if there is that one magical solution or a ledger that can maintain all of these assets and move seamlessly between these assets for the banks, that's what the bank wants.
You've been in the industry where you've seen a lot of in the internet banking era, the mobile era, the cloud era, and now there's the AI, tokenization, agentic systems, and the likes. How do you see the core promise of transformation? We've been hearing, transformation in the last almost 20 years now, 30 years. How confident are you about these new types of transformation that banks have to go through?
There is no one answer for everybody. I mean, of course, the banks that have been here for a long period of time, the GSIBs, typically are slow moving. And it's a consequence of a couple of things. Like we discussed earlier, trust is a major factor, right? So they and their customers have to move through this in a manner where both the banks can do this carefully and the customers trust them that even though they may be slow, they will get them there in the right manner. And secondly, it is difficult, not
Yeah.
only the fact that there are a lot of legacy solutions with a lot of bolt-on spaghetti code where a lot of bankers have moved on and they may or may not even know what that particular code or solution does. And it takes time in a manner to unpack that in a trusted and responsible way. And so I'm pretty sure that a lot of us in the industry, as well as a lot of consumers, are asking them to move fast, but at the same time, move responsibly. But I think what digital banking, mobile banking taught us in the last 20 years is that while I did say that it is very simplistic what banks do in terms of keeping an asset and providing a value when I have to expend that asset, for me to be at the bank and for the bank to keep me with them so that they don't become a utility, digital banking and mobile banking taught us that experiences for the customer is what keeps them there, while the utility and the trust is what will keep them for the long term. And this is why a lot of people leave the bank when the neo banks or the challenger banks or the Robin Hoods or the Revoluts come, because they are able to show me the way I send an email or the way I'm able to buy a product off Amazon is the same way now that I can trade or I can buy stocks or I can move my money or I can pay for my coffee. So experiences is what keeps me with the
Yeah.
banks. And that is why banks, rightly so, are investing in the digital banking experiences, seamless banking. And this will be another small story in the big effort that the bank is putting to make banking seamless for me as a consumer, for you as a consumer, where when I go and swipe my card, I don't have to worry about whether it is stablecoin or USD or SGD or carbon credits or a loyalty point where I'm sweeping it. Because as a consumer, I'm going to buy that coffee or buy that bread or buy that experience at the point of sale, and hopefully, behind the scenes, the bank has enough agents who understand me, my pattern of buying, my pattern of spending to give me the best way at that point of sale, at that point of time, understanding the
Yeah.
markets and my preferences to whether route that payment through stablecoin, USD, SGD, loyalty rewards, or whatever else comes in the future.
I've got a final question for you, and this is around Thought Machine. If every bank in the world adopted the Thought Machine's platform, the full native, real time, AI native, and tokenized ready, what do you imagine the global financial system to look like in the next 10 years?
Banking will become an invisible infrastructure as it should be. Also, answering your previous question before I go ahead and then elaborate this a bit more, in terms of institutional money, right? Money for institutions, it is even more important because it is high value money. If a bank and its correspondent
Yeah.
bank can work together for an institutional customer, where it can move money at the
Yeah.
machine of speed 24/7, finding the cheapest route and finding the fastest route. That is the promise of stablecoin, crypto, tokenized assets, or frankly, any other
Yeah.
innovation in payments that we are trying to do right now. And then coming to everybody, every bank having a modern core with real time data, event driven,
Yeah.
API based solutions, it will only make this dream a reality. 24/7 machine speed, internet speed, 24 banking that becomes infrastructure, invisible reality for all of us.
That sounds very ambitious. I'm really looking forward to that future because in the last several years, that promise of invisible banking has been very theoretical. But I think as we begin to see the new wave of digital money in itself, I think it's going to be very interesting to see what that looks like in the future. Namit, thank you so much for your time. It's been
Thank you,
an
Ace. Thanks
exciting
for having
time
me.
having a
Pleasure.
conversation with you today.